what capital gains tax really means for your estate. When you own assets like stocks, real estate, or business interests that have grown in value over time, you have what's called unrealized capital gains. These are the profits that exist on paper but haven't been taxed yet because you haven't sold the assets. The problem comes when you pass away or when your heirs eventually sell these assets. Without proper planning, your family could face massive tax bills that could have been completely avoided. Here's a real example from my practice. I had a client whose parents bought farmland in the 1970s for roughly $50,000. When they passed away, that same land was worth $800,000. That's $750,000 in capital gains. If their children had to sell that land without proper planning, they would have to face capital gains taxes on the entire gain, potentially costing them over $150,000 in federal taxes alone. But because we implemented the right strategy, their family paid zero capital gains tax. That's right, zero. So the first strategy you need to understand is called the stepped up basis rule. It's one of the most powerful tax benefits in our system. When you inherit assets, the tax basis of those assets gets stepped up to their fair market value on the date of death. This means all the capital gains that built up during the original owner's lifetime are completely wiped out for tax purposes so long as the asset is still in the decedent's taxable estate. Your heirs inherit the assets at their current value, not what you originally paid for them, as long as it's part of your taxable estate.